Hello, welcome to AleaSoft webinar. My name is Alejandro Delgado, Technical Director of AleaSoft and Associate Partner of Alea Green, and thank you for joining us today in this webinar with the topic Prospect for the Energy Markets in Europe for this winter, Renewable Energy Projects Financing. Our first speaker today will be Oriol Saltó, Data Analysis and Modeling Director of AleaSoft and Associate Partner of Alea Green, that as usual will analyze the evolution of the European energy markets and the prospect for the coming winter. Then we have several guest speakers from Deloitte, sharing this session with us for the fourth consecutive year, and that we talk about the financing of renewable energy projects and the importance of price forecasting in audits and portfolio valuation. They are Carlos Milans, Partner of Financial Advisory, Álvaro Antón, Director of Financial Advisory, and Bárbara Cueto Felgueroso, Director of Corporate Treasury Advisory Services. If you have any questions at any time during the webinar, please use the Q&A menu and we will answer them after the presentations. And now, I hope you enjoy the webinar. Oriol, please share your slides.
Thank you, Alejandro, and good morning, everybody. I'll start right away because we have invited the speakers today. So, and there's been 6 weeks since our last webinar, so there are quite some things to explain in the energy markets. Interesting times in the energy markets, as always. I will start with a brief introduction of the AleaSoft and the energy and the services that we provide, in case you don't know us. In AleaSoft, we provide forecasting energy services for the energy, forecasting services for the energy sector. We cover most of the energy markets in Europe. We are also covering some markets in South America, also in North America, and our goal is to expand globally to cover all the major energy markets, also in Asia. This year is the 24th anniversary of the company, and our goal by the end of this year is to fully cover the 35 European energy markets. This means covering both electricity and gas markets, and also covering them in all the horizons, starting from the short term up to the long term. We forecast basically any variable that can be interesting for the energy sector. Obviously demand and price of gas and electricity markets, but also any variable that impact the prices, that impact the demand of these markets. And we build solutions for any player in the energy sector. So as clients, we have TCOs, producers, being it utilities or IPPs, consumers, large consumers, retailers, etc., and also investment funds, traders. We have applications for control centers, sponsors of renewable energy projects. So basically, any player in the energy market at some point will need forecasting services at the short, at the mid, or at the long term. The methodology that we use for forecasting is a methodology that we ourselves developed specifically for forecasting in the energy sector. The main 3 points that we always like to stress about our methodology is that it is a completely scientifically based methodology. It's a hybrid method combining several statistical techniques combined with artificial intelligence and machine learning algorithms. This gives our forecast very consistent results. This is one of the main points that our clients appreciate about our forecast, their consistency over time. And well, it's the methodology that we have been using for 24 years now, starting in the Iberian electricity market, and now covering all the markets in Europe and even markets in America. So let's start by seeing how in the last weeks the fuels and CO2 markets have been evolving. We always start with the oil prices. Oil price is kind of an index of how the global economy is going. As right now, the global economy is based in fossil fuels still. So basically, the Brent oil is telling us how the global economy is going. So since basically in the last month, since the end of June, we have seen a raise, an important raise in oil prices. Up until mid-September, the rise was 34%. Right now, they are a little lower. Basically, this rise in prices was due to the cuts in production and even just the announcement of possible cuts in production raised the prices. Also, uncertainty, geopolitical uncertainties in Ukraine, now also in the Middle East, are pressuring the prices up. Prices are rising, but mainly due to the let's say factors in the supply side, as I mentioned. But on the demand side, things are not pointing in that direction. So the main one of the main oil consumers in the world, that is China, their economy is not increasing as expected after the several COVID crises that they had. So on the demand side, there are really no signs for higher prices at the long term. But right now, it looks like the factors in the supply side are the ones that are having the most of impact. So now that prices are close, or they were close to $100 per barrel, the question is for how long they are going to remain there. And according to most of the experts and analysts, they don't see prices being at that level of $100 for very long. So most of the analysts, by the end of this year or by the first quarter of next year, they are seeing prices going down again. Mainly because, as I mentioned, the demand side is not putting pressure on these prices. So at the long term, we are seeing mid-term, we are seeing these prices going at least going a little bit down. For the gas prices, these are the TTF prices, so it's the benchmark in Europe for gas prices. What we saw is that since the beginning of the year, prices went down from the energy crisis that we had in 2022. Prices went down to 25 euros megawatt hour, and then they bounced first to the 40 euros, and now they are back, or they were back a few days ago, they were back to the 50 euros megawatt hour. Again, this is, as we will see, even if Europe has their stockpiles of gas basically full, as we will see in the next slide, there is some fragility in the situation on the supply side, as we have no longer gas from Russia. That was the main supplier before the crisis. So we are basically we are relying basically on LNG, and the global supply of LNG as is some kind, well, it's a little bit fragile. So any news about possible disruption on this global supply are affecting prices. And as I mentioned, these are the reserve levels for gas. They are basically full. We are close to 98%, basically. So looking at the winter, there should be no crisis on the supply side. So we should have enough gas for the winter, unless it's a very extreme winter with very cold temperatures, but it doesn't look to be like that. Also, the demand, it's been decreasing since the last winter, so more than 15% on average on all the European countries. So with less demand and let's say average temperature winter, we should have no problems on the supply side. But as I mentioned, as we are relying basically only on LNG, any possible news about disruptions, like on the last webinar, we saw the repercussion of the announcements of possible strikes on a liquefying plant in Australia that cost higher prices. Now the problems in the Middle East are also pressuring the prices up. But again, no critical situation on the supply side. It's expected during this winter, but as we are only relying on LNG supply, prices may still fluctuate a lot. And in the last webinar, we saw the results of the second tender for the European Union joint gas purchase. There's been another one by the end of September, and basically we see how the matched gas, or the total volume matching offers from the supply and the demand side. We are consistently getting values around 20 billion cubic meters. So and as it looks that this kind of joint purchase strategy works, we have the European Commission said that why not trying to replicate this kind of joint purchase strategies for other commodities, let's see, or raw materials even. So let's see, it's something that it looks that it's working. So let's see if they are going to try to use this strategy on other commodities or on other materials. And for the CO2, we are seeing basically the same trend that we have been seeing for the last month. So basically, prices slowly moving away from this 100 euros per ton barrier that have never been crossed, and still a lot of volatility. CO2 prices has an impact on electricity market prices, so we are still seeing some volatility that is impacting electricity prices, but on average prices are moving away from this barrier of the 100 euros. So in the midterm, we don't see prices starting increasing rapidly. We know that at the long term, prices of the CO2 are expected to raise, to grow, because this is the CO2 allowances are basically a tool to incentivize switching from fossil fuels to greener fuels or fuels with less emissions. So basically, for this tool to work, prices have to increase over time. So at the long term, we expect these prices to increase. But right now, the trend is not pointing in that direction. So for the next month, for the next weeks, prices will not be close to the 100 euros. Now, let's go to see the evolution in the electricity markets. And as always, I take this opportunity to show the energy database, the online energy database that it's a service that we offer to our clients, where you have all the data in the same format, always updated. So very critical in this energy sector to have always updated data available. So those are the monthly average prices for the main electricity markets in Europe. And this is from since 2020. And the last full month that we have is September. And basically compared to August, that was the last full month that we had in our last webinar, prices are really quite stable, although they are at around 100 euros megawatt hour. That are well, high levels compared to where we were before the energy crisis. So stable, but at high prices. Spain, Germany, Portugal increased a little bit, around 7%. Italy and Belgium increased a little less, around 3%. UK basically stayed flat, and France was the only market that decreased a little bit, but less than 3%. If we look closely at the last weeks, this is the daily average price for these markets since the 1st of August, and we see how the trend is basically following what we saw in gas prices. So since the second week of October, with the increase of gas prices, we see a general increase in electricity market prices. The most expensive markets, Italy and Spain and Portugal, basically because with the increase of gas prices, prices in general increased, but most of the Northern European countries had more wind production during these days, so they felt a little less this increase in gas prices. But well, right now also Spain is having a lot of wind production, so again, it's only Italy that is having really high prices compared to the rest of the markets. And some more things that this is what I was mentioned. In blue, you have the prices for a Spanish market, and in yellow, you see gas prices. So when gas prices started increasing, also electricity market prices in Spain started increasing. You see how in red you have the wind production. So wind production really low, really didn't help to reduce prices. But yesterday, well, those are the prices for yesterday. So when wind production started increasing, Spanish prices really decreased. And just to show you other things that you can see in our platform, those are the hydroelectric reserve levels for the Spanish market. And you can see how in 2022 we had a really bad year with hydroelectric production with very low reserve. We are in a really drought period. Right now we are a little bit better this year, but still we are much below the average levels of hydro reserves. Okay, I'll go back to my slides. Just mention that in our website you can find a list of all the reports and all the analysis that we have available. We have a long-term forecasting report for all the markets that you saw at the beginning. These are the most demanded markets, but we cover all the demands, all the markets in Europe. We have analysis on PPAs market. We also analyze individual projects for batteries, for renewable energies, etc. You have the full list in our website. So now let's go to see now what the futures market are telling us about what the market agents are seeing right now for the mid and long term. This is the forward curve for the futures market for oil prices, for Brent oil, and basically we are comparing here to the curve that we saw in our last webinar, so 6 weeks ago. Basically, even if oil prices have been increasing, as we have seen at the beginning, the forward curve is basically showing exactly the same prices, even lower prices at the short term. So as I mentioned, the demand side is not really putting pressure on prices, so we don't expect these prices to be at the level of $100 for long. So at the long term, everything points that the prices are going to go down again. Long-term price around $70 per barrel. For gas prices, this is the forward curve for TTF gas. We see an increase for the rest of 2023 and 2024, 2.5%. This is basically reflecting the increase in the spot prices that we have seen, but at the mid and the long term, we are seeing a decrease in the expected prices or the prices that are being paid now for the gas that will be delivered at the long term. So starting from 2025, the curve is decreasing. The major decrease is in 2029, around 8%. And with this decrease, we have the recovery of the prices that we had before the crisis, that before it was in 2028, now they are back in 2027. So according to the forward, to the futures prices, we should be back to the pre-crisis levels around 2027. And the forward curve for the CO2 prices, basically no difference, just decreasing a little bit following the decrease in the spot prices. And looking at the futures market for the electricity prices, Basically, no change in markets like France, Germany, and Italy, but we see an important change in the Spanish market. So increase, really important increase. This is, well, it's comparing 6 weeks ago. 6 weeks, it's there are some weeks, but looking with some perspective is not a long time. And we see increases of nearly 15% in the first 3 years, and no changes in the rest of the year. So different behavior. This increase was basically a level change. So this is also a reflection of the how volatile are these futures market. They are very liquid markets, so just one transaction, single transaction can make huge changes in the prices. And I am reaching the end of my time, so I would just commenting key points, things that we have to keep in mind when forecasting energy prices for the future. Also, as a kind of a summary of what we have said, rental prices approached the value of $100 per barrel, but they look, or more or less everybody agrees that they are not going to be there for much long. Volatility in gas prices, even we have stockpiles really at very high levels. There is some fragility in this market, so we are seeing high volatility and also high prices. CO2 prices moving away from the $100 per ton, and electricity market prices basically following the gas prices increase in the last weeks. The forward gas prices, as we have seen in the midterm, they say that we could return to the pre-crisis levels around 2027. Before it was 2028. But in previous webinars, we saw that this return was expected before it was expected by 2026. So we are moving around this 2026-2028 range. And in the longer term, we are seeing basically the same situation. So at the long term, prices will be driven by renewable energy generation, battery storage, green energy production, and the hybridization of all these technologies will play a key role in the energy transition and key role in the electricity markets. And that's it. Just let me already invite you to our next webinar that is going to take place in November 16th. And we will be talking about batteries and energy storage. So very interesting. We will have Luis Marquina from the Association of Battery. Thank you, Alejandro.
Thank you very much, Uriol, and thank you, Carlos, Alvaro, and Barbara for sharing again this webinar with us. Carlos, when you're ready, you can share your slides.
Yes, good morning, everybody. Let me just share my screen. Okay, I hope you see it now on the screen.
Yes.
Thank you very much, everybody, for your attendance today. As a general introduction, most of you, if not all of you, I'm sure you know Deloitte. We're the largest professional service company in the world. And particularly, I'm in charge, together with my partner, Jaume Pujol, on the corporate finance department, exclusively dedicated to energy. And we can provide advice out of corporate finance and also financial advisory in the whole value chain of life cycle of our renewable assets, whether that's permitting, licensing, providing detailing services, including technical, financial, legal, tax. We can search a partner for your particular project. We can certainly arrange financing and PPA structuring. Also, during that phase, and it's very important in the pre-financing and pre-PPA structuring, to have the support of complex accounting advisory, as we will comment a little bit further in the presentation. Then everything post-construction, including construction, operation, audit and assurance, financial information and reporting. So all the product offering that we can deliver to the table, so you have a one-stop shop in relation to renewables at Deloitte. Having said that, we're going to provide a broad view of how financing conditions and markets are now behaving in the Spanish market. So you can have a view on how to finance, how to approach that, and the interaction that all these will have together with financing conditions, interest rates, PPA conditions, etc. In order to have a broader picture, we always love to start saying that the energy transition is unstoppable. Okay, some people may agree or disagree on how fast and how deep all this will take us, but what is clear, this as facts, is the feed-in tariff has disappeared, at least in the Spanish market a few years ago. So grid parity is now a reality. The energy transition enables decarbonization, which in essence is good. Okay, it's one of the 3Ds of the energy transition. And in this sense, the European Union has set up very ambitious targets in terms of renewable penetration. In the particular case of Spain, and this has been recently reviewed in the National Energy Plan, what we call the PNIEC, right, of around an additional 100 gigas of renewable projects by 2030. This, on an overall basis, aggregated basis, it will imply the mobilization of over 110 billion euros in investment, right? So the energy transition is unstoppable, but certainly brings uncertainty, right? As Oriol was mentioning, there are volatility in certain key variables affecting power prices, and this can be demonstrated by the fact that these are historical prices in yellow from 1998, okay, where we saw very stable prices, and therefore electricity prices, it was not a major concern for most of the players, whether generators or electricity consumers. And then, as a consequence of pandemic, gas prices, Ukraine conflict, and others, CO2 prices, we saw a very large spike. And what we see going forward is this volatility that Oriol was mentioning. And we have tried to show you here central, high and low market advisors projections together with the futures, which is the OMIP, okay? And you will see that the dispersion and the price range is enormous. So this is the kind of uncertainty and volatility that we'll need to face and manage over time if we want to play a role in renewables in the coming, in energy in general, but in renewables in particular in the coming years, as is said to be the higher penetration technology in the future. You will see that this high volatility is evident, as here we have tried to put two examples on central case and low cases of the same market advisors and what they said about future prices in different quarters in the past, right? So from Q1 2022 until Q3 2023, you will see that in the first part of these charts on the left-hand side until year 2027, 28, 2030, there is still a lot of dispersion, and consistently over time, the market advisors, they had to adjust their projections in order to cope with new uncertainties and new situations in the market, right? As you will see here, probably from 2029, 2030 onwards, there is more homogeneous projections, despite having been produced in different quarters over time. But again, this is an example of how uncertainty and volatility it is one of the main ingredients that we should cope with in the future. So which are the ingredients of success in order to achieve the ambitious goals of renewable penetrations, at least in Spain, is that we have good renewable resource in terms of wind and solar. We have the technology available. We have a very capable human capital. Okay, we have been investing in renewables since the late 90s. An example of that is that before the huge improvement in the capex of solar PV, Spain had wind turbines installed in Spain over 20 gigas already 10 or 15 years ago, right? So we have very good human capital in Spain that have been able also to export those abilities elsewhere in other jurisdictions. Okay, we had good policies. Okay, maybe there are some things that could be improved. There are many gigawatts trying to and obtain a proof connection to the grid, and this has created a little bit of bottleneck or a huge bottleneck in some cases. But in general, because now we are in grid parity and we don't need feed-in tariffs anymore, the regulatory uncertainty is very limited or inexistent. Okay, and obviously the third ingredient is a lot of money within the form of equity, which seems reasonable long-term returns. Okay, and has an opportunity cost of investing the same money in other sectors and in the same sector in other jurisdiction, and the debt providers, which obviously, as you very well know, are more risk averse than equity investors and look for long-term cash flow stability, right? And also, any international lender can also face the difficulty of whether deploying money and lending money in a particular country or in another one, which has more a stable situation or has better returns for the capital. Okay, so in this point of view, equity and the providers, they all seek the same with different risk profiles. So merchant risk is the new player. Okay, volume risk is accepted, especially in wind. It is much more predictable in terms of all the generation and how much energy is going to be produced by solar PV assets. Wind is certainly a little bit more erratic in terms of when it is produced, but also the volume risk is acceptable, but price risk is not so much, right? So this is one of the key variables when talking about financial renewables that we need to focus on. Okay, this is a major disruption for shareholders and lenders. Okay, and they need, in order to face this, it is essential that equity investors and lenders have a view, their own view, or a third-party view. They rely on third-party views on how long-term electricity prices are going to behave, as Oriol was mentioning, right? In relation to the financing and merchant risk, there is an easy part and a not so easy. The easy part is that CapEx, OpEx, tax assumptions, etc., are commonly shared by shareholders, so equity investors and lenders. Okay, with the exception of small differences, the tenor provided or offered by different lenders, whether they're commercial banks, multilaterals, etc., are similar in similar terms. In terms of tenors, we're now seeing between 16 to 18 and even 20-year on fully amortizing deals. Cost of debt is typically Euribor plus 2.5%. Typically, probably starting a little bit lower with step-ups every 3 years, but more or less all the lenders will offer similar pricing conditions for their financings. Okay, a few will prefer mini permit structures with their financing risk, while some others doing that will give you in exchange as a trade-off longer underlying tenors for debt sizing purposes, right? One main difference between sponsors or equity investors and lenders is typically lenders use the P90 production cases for debt sizing purposes, okay, while shareholders use P50. Obviously, always equity investors are a little bit more aggressive and more optimism that lenders. But having said that, this is the easy part, right? The not so easy part certainly is the pool price assumed by lenders for debt sizing purposes, and the difference on the prices assumed by sponsors, which I said are more optimistic, right? Recently, there is another variable that we need to take into account in terms of potential difficulties with lenders and how they will cope with this. It is the curtailment risk, okay? As the penetration of renewables increases in certain nodes in the network, there will be more saturation, okay? And eventually curtailment risk could be a case. So it is important that you, if you are working in the renewables in Spain, you also count with the assistance of an advisor that has a view on which nodes and regions are more likely to suffer curtailments than others, okay? So at this point in time, we observe a mismatch in the long-term pool price forecast between lenders and shareholders. This is exaggerated and exacerbated by the fact that because of high volatility, the difference between central scenarios and low scenarios is higher, and therefore the difference between how equity investors perceive potential pool prices in the future as opposed to lenders is significant, right? So in this situation, it is essential in order to arrange financing and also to achieve the construction of a project and to achieve a financing of a project is to partially mitigate the price risk through long-term pool price strategies, through the use of PPAs, futures markets, and other potential strategies, right? Having said that, I will then leave the word to Álvaro Antón, who will get into the nitty-gritty details of how today banks are lending and are proposing terms and conditions to sponsors in order to finance renewable assets in Spain. Álvaro, floor is yours.
Okay, if you want, Carlos, if you can stop. Okay, I will now share my screen. So good morning to everybody. So as Carlos was mentioning, this risk, the price risk is quite an important element to be analyzed by lenders. So therefore, lenders they are approaching to this situation under two potential scenarios. One scenario is
Álvaro, we are not seeing your presentation.
Sorry, 1 sec. Yeah, correct.
Now, yes. You can put it in full screen mode again.
Yeah, sorry about that.
Great. Yeah.
Okay, so I was mentioning, banks typically approach to this scenario under two potential, approaches. One is there is banks that they are going full merchant, which means that they has been analyzing the volatility of the electricity price. We have to say that there are not that many banks that can cope with this risk without a PPA. We say that there is around from 3 to 5 lenders that can cope with this risk, but the reality is that the envelope for this risk is not that much. So we have observed that typically transactions between 50 megas to 100 or maybe 150 megas can be financed on a merchant basis, but certainly anything above those levels will not be possible to finance on a merchant basis, or it's going to be very difficult. And in exchange, lenders will take a very conservative approach in order to mitigate the volatility of the price. So therefore, the majority of lenders, they will be comfortable going with a PPA for the financing, which means that large portfolios will require and will need a PPA, not necessarily PPAs for the tenor of the debt. Now we'll mention. But certainly some degree of PPA will be required by the credit committees of these lenders. And another thing is that under these circumstances, PPA levels, they are as well moving aligned with the movement of the electricity market. Therefore, when you are structuring this transaction with a PPA, you need to take into account that those contracted revenues may vary from the beginning of the negotiation to the end of the negotiation, depending on how the market, the electricity market has moved. Therefore, how the off-takers will try to approach to this risk and try to secure adequate levels for them in order not to get into difficulties for their positions with the market. In that sense, what we have seen is the most common structures for the PPAs are the swaps and the floors, and certainly a combination of both of them. For the swaps, as you may know, this is a contract where a fixed price is settled for the period of the PPA. What we have seen is levels now. Well, this is as I mentioned, this is moving with the market, but what we can say is we are seeing levels within 40 to 50 euros per megawatt hour for PPAs on 10 years of maturity of tenor. The point for the swaps is that this is bringing better leverage or higher debt quantum for the project. However, because there is a fixed price, there is no upside for the sponsor. This typically implies a lower equity IRR for the sponsor. These swap structures, they are quite common, quite frequent, and certainly lenders would prefer this structure rather than the floor. But certainly floors is something that lenders are accepting. The floor is the structure of the floor is a strike level. What we see is the levels that we have seen is around 30 euros per megawatt hour in exchange of to pay a premium, a yearly premium, and that premium typically goes within the 4 euros to 6 euros, 7 euros per megawatt hour. The thing of this, the point of this structure is that this is bringing better IRR for the sponsor, because there is a way that the sponsors will capture the upside of the electricity prices when they are higher than the strike. However, this implies that lenders will take a more conservative approach, because there is certain less contracted revenues. Therefore, the leverage for the transaction will be lower. However, what we have seen is that certainly lenders, they can accept these structures, although they will try to do a lot of sensitivity scenarios in order to understand what will be the break even of the structure in terms of price of electricity. Then, as we mentioned, combinations of swaps and floors as well is quite common in the market, and in relation to the tenor that I mentioned before, what we have done is we have grouped tenors within those three groups. Tenors from 1 to 5 years. There is high liquidity, but the problem here is that lenders will not accept this tenor. Lenders will need to have longer tenors in order to comply with their credit committee's requirements and to mitigate the merchant risk. So what we have seen is lenders will be accepting from 8 to 10 years. I mean, 8.5 years is something, borderline. Anything above that will be more than welcome for the lenders. The thing is not that easy to find off-takers that they would like to provide these tenors. So what we see is the sweet spot of the PPA that are currently crossing the market for the project financing is more in the levels of 8 years, from 8 to 10 years. What we have done here is we have recreate a simulation of how would behave a standard PV project depending on three financing scenarios. What we have assumed is quite a standard variables, which is energy yield for a PV is 2,000 net equivalent hours, degradation, a capex which is aligned with the latest levels that we have seen is around 700k per megawatt. Certainly that has been moving upwards in the past. Now that is being going a little bit lower down. But this is something that will depend and will be key as well for the equity IRR for the sponsor. Development fees, again, we have included 130k per megawatt. That's an assumption that is quite common in the market. That this as well is quite volatile depending on the project and depending on the money market. Then O&M and insurance and land. Well, we've used variables that they are quite common and quite standard in the market. The PPA that we have used for this exercise is a PPA which is covering 70% of the P50. This is the levels lenders will be expecting. Anything below that will be difficult. I mean, some lenders, they can accept 65% of the P50 to be covered, but the bulk of the lenders will be requiring a coverage of 70%. And we consider 10 years PPA, a 10-year PPA precisely because of what I mentioned is what the lenders would be expecting. In terms of debt sizing, the sizing, as Carlos was mentioning, we are using the P90 pool price. We are using mid-low. Typically, lenders dimension debt with the lowest scenario. Now, with the decrease of the projections of the market advisors since early this year, debt quantums dropped dramatically. So now lenders, they are trying to find structures or ways to include the mid-low scenario for the dimensioning, because otherwise the projects will be suffering with low leverage. So mid-low is something that is feasible in the market at this moment. And then debt tenors is, we are using 20 years for the scenario where there is a PPA with a cash sweep reducing in 2 years. If the scenario is on a merchant basis, we have assumed 18 years with a reduction of 2 years with cash sweeps, and margins is what Carlos was mentioning, is agreed starting 200 for construction, and then during operation starting a little bit lower, but increase of 25 basis points every 5 years, which is quite a standard. So this is a very standard approach of a project finance for a PV project. Then what we are trying to show here in this table is you will see how the greens are those cells, those scenarios where the IRR of the transaction is above 8%. So what we have done is we included here the sensitivity of the different productions that a PV may have. And here what we have done is we have assumed a flat price of the pool price within 50 to 75 euros per megawatt. We know that this is not the reality, but for illustrative purposes, it's better to have one level flat, so you can see how the IRR is behaving with this. In this scenario, we are using a full merchant, so there is no PPA, and as we mentioned, full merchant will not have the better leverage for the transaction. However, IRR will be the highest because, as we mentioned, PPA is destroying value because it's capturing part of the value of the projections of the electricity price. Therefore, IRR is benefiting from higher scenarios in case the sponsor believes that the pool price is going to be on the central or even on the highest scenario. So if you see here, there is a large amount of cells in green. If we go for a scenario of a 10-year swap at 45, you will see that the green cells has reduced substantially. Therefore, this is the effect that we are mentioning, that PPA is destroying value. This is the fixed price. At the end, it doesn't matter if the pool price is on the 70 levels, because the revenues that will be captured by the sponsor and by the project will be on the 45, which is the level of the PPA that we have assumed. Therefore, you will see that there is less IRR on the grid. However, that will be increased because at the end, what you are doing is you are using you are using a higher amount of contract revenues, and therefore those contract revenues are benefiting from a lower debt service cover ratio, which typically for merchant revenues, for contracted revenues is 115, and for merchant revenues is within 145, 140. Therefore, this is how is behaving the project. If we go for a transaction where we have a floor, then the floor, as we mentioned before, will be benefiting partially from the upside of the price. So therefore, for pricing of the pool price 75, well, this is capture price of 75. You will see that now we have all in green the IRR because it's capturing all that difference. However, there is less greens than compared to the previous scenario of the merchant, and the level of leverage will be a little bit lower compared to the swap, but certainly a little bit higher compared to the merchant. So this is I think this is very visible how is behaving the project with the different structures. Therefore, what we include here again is the previous slide with the evolution of the pool price. So again, what is key for the lenders and what is key for the sponsors is this is how the market has been behaving in the past, and high volatility in the past 2 years. Now the projections of the market advisor is going to be key for the lenders in order to approach this merchant risk and try to be more comfortable or less comfortable and try to move from the fully contracted or for the contracted revenues to a more merchant revenues for the project finance purposes. Therefore, the main conclusions here is that certainly renewables is this type of business that is completely feasible with adequate profitability. It's difficult now to find double-digit IRR. However, for this level of certainty, IRRs within 8 to 10%, we believe is a very good investment scenario for the sponsors. Then the use of debt is key for the development of all of these renewables, and certainly the more lenders take comfort of the merchant risk, the better for the sponsors and the better for the lenders, because I mean, it will be less complicated to have to close the transaction without the interaction of an off-taker. As we mentioned, PPAs and off-takers destroy value because they capture part of the value, and that's obvious because that is their business. They will need to earn money for this type of products. Therefore, as a final conclusions is what is key for the development of all of this investment that is coming in the near future is certainly the development of the future markets, you know, the OMIP and other parallel markets, in order to make more objective, more easy to predict the price of the future of the futures of the electricity. That will be key as well. Development of auctions, which will bring certainty to all of these projections and uncertainty on the prices, and certainly the understanding and the evolution of the lenders of what means the merchant risk. Therefore, you know, will allow or will make easy the financing of all of these projects, which is going to be huge. As Carlos was mentioned at the beginning, we expect more than 100 billion euros of investment within the next 5 to 10 years. So, Barbara, I think.
Yes, thank you, Álvaro.
Yeah, let me stop sharing.
Okay, do you see my screen now?
Yes.
Yes.
If you can make it full screen.
Yeah. Okay, so I just have 5 minutes to talk about this topic that I think it's very relevant, is the evaluation and accounting implications of the PPAs. We work with our colleagues, with Carlos and Álvaro, we introducing the preliminary review and subsequent valuation and accounting treatment of PPAs, because we consider that this aspect is really relevant and is being really relevant in order to avoid accounting impacts in your financial statements. That's why we always recommend to analyze all the implications of the PPAs before its closing, and to discuss with the auditors to ensure that the valuation accounting procedures after before closing the PPAs are agreed. So after the closing, you can be sure about the potential accounting and financial implications that you can have. Just to give you an overview of the market or what we see in the market when we analyze PPAs, In the past year, we have analyzed around 50 PPAs, being most of them financial PPAs. And I'm going to explain after that the implication of having financial PPAs against physical PPAs. And most of the structures that we see are swaps with maturities between 5 to 10 years. But we also see PPA structures with options like a floor, put spread, or also collars with a cap and a floor. In terms of pricing, what we are seeing now, and take into account that we see all the market, we see all type of profiles, base load, solar profiles. We see all types of clients. In terms of swap pricings, what we see is an increase in price around this year, starting between 40 and 45, but we are seeing now prices of around 60, 65 euros per megawatt. But if we focus on only solar profile, the prices that we see are around 40, 45 euros. In terms of options, the prices that we have seen this year, and if compared to past year, are almost the same between, one second, I don't see here my screen, between 30 and 40, and with premiums between 4 and 5 euros per megawatt. Focusing on the accounting treatment of PPAs, what it is important to take into account is which type of PPA we have. We have mainly two types of PPAs: the physical PPA, which is the preferred PPA because it is not registered as a derivative and it doesn't have implications in terms of balance sheet impacts. But in most of the cases, what we see in the Spanish market are financial PPAs, which are recorded as derivative, and then the fair value is recorded in the financial statements in profit or loss account, or if you can apply the hedge accounting requirements, this derivative is recorded in OCI, avoiding the volatility in the P&L account. But also, sometimes when you have physical PPAs, which is the most preferred option for our clients, you also have to take into account that sometimes, and we are seeing a lot of cases right now, like for example, with the take or pay clauses, there are certain clauses inside the contracts that are considered as derivatives. So we insist you in analyzing since inception, since the negotiation phase, all the clauses that are included in your PPA in order to be ready to act accordingly to the accounting treatment and avoid unexpected accounting impacts in your financial statements. If we go to the fair value issues, as we said, in most cases we have financial PPAs which need to be calculated. When we calculate the mark-to-market of the PPAs or the fair value of the PPAs, we have to take into account that we have different types of PPAs, linear, optionality, combined structures with different types of underlyings, with the base load, peak load, solar, wind, whatever. And we also need to be clear about the resources or the market data that we have in order to calculate the market value. You know that in the Spanish market, we don't have a public, liquid or observable market curve. That's why we always recommend you to have a resource, a market curve, like the one that, for example, AleaSoft can provide you to calculate a robust mark-to-market valuation that can be used for the accounting and also during the negotiation process. And taking into account the valuation models differ completely between the structures. It is true that in most cases we see swaps, which are evaluated with the simplest valuation model. But when we have options like floors, we need to introduce the concept of volatility, and we have to introduce other type of valuation model, like for example, Monte Carlo. Just to finalize with this phase, we want to conclude this second part of the webinar, emphasizing the importance of analyzing the economic and accounting implication of the PPAs before they come into force. that we have seen several times that financial PPAs, for example, can be a deal breaker because of the difficulty of calculating the mark-to-market and because of the fear of having an speculative instrument generating a lot of volatility in the P&L account. With regards to the first aspect, remember that AleaSoft in this case is your perfect provider for price curves for the valuation of your PPA structures. And also with the accounting implications, if you analyze the PPA since its inception, you can detect potential accounting implication that can be negotiated before closing the PPA in order to avoid and in order to be ready to comply with the hedge accounting requirements. So based on our experience, and always that we have anticipated this analysis, we have achieved a successful application of hedge accounting that has allowed the client to stabilize the income statements and to avoid potential P&L impacts not desired. So I don't know if I am on time. Thank you very much for your time. And I don't know if there are questions that you want to ask us.
Thank you very much, Carlos, Alvaro, and Barbara, for that great presentation. And thank you for sharing this webinar with us again. We hope to see you again next year. And unfortunately, we have run out of time. We have already answered some of the questions already. We will answer the remaining questions directly by email. As Oriol mentioned, I invite you to register to our next webinar in November. Thank you again, Oriol, Carlos, Alvaro, and Barbara for your presentations, and the audience for joining. Have a nice day.
Thank you. Bye-bye.
Thank you. Bye.
Goodbye. Thank you, Alejandro.